Unlock Kansas City's real estate insights in today's dynamic market landscape.
What's up, everybody? Logan Freeman here with another episode, Season 2, Episode 11 of the Kansas City Commercial Real Estate Market Pulse. We got a market signal here for you, a little impromptu, but there's been too much going on that I couldn't hold back. I needed to come on and share what I am tracking on a regular basis, what I'm seeing in the market. And that's exactly what we're going to do today. And why tracking transaction volumes as a commercial real estate advisors to owners actually matters. So a couple things here, 5 to be exact. Number one, it gives you a real market clock, not a media lag. So transaction volume, that data tells you where the market is, not where it was 90 days ago when the press release got published, but when volume drops sharply, capital's pricing in risk before pricing shows up in comps. And then when volume recovers, it signals institutional and investor confidence returning before the headline cap rates move, right? So you see the turn before your clients do. And that's why it's important to track the commercial real estate transaction volumes, not only nationally, but also in regards to your specific market that you're focused on. We are live here on LinkedIn. So if you have any questions for me today, treating this a little bit like an office hours, please do drop them down into the comment section. I'll be looking at that. But number two, it separates pricing reality from the asking price friction, right? So a market with 40% fewer transactions in the prior year, but stable asking prices isn't a stable market, okay? It's a frozen one. And owners who don't transact don't mark to market. So tracking that volume tells you when the bid-ask spread is wide, and it helps you counsel owners on whether their number is a real number or a wish. Number three, it gives you credibility in the room, so that really no comp sheet can, right? So if you're walking into a meeting and you say, hey, here's what's sold, here's how many deals are actually trading, and here's what that trend line tells us, that's a fundamentally different conversation than just showing comparable sales and leases. Okay, so volume data positions you as a market analyst, not just a listing agent. And owners, they want to make decisions based on advisors who understand the full picture. Number four, it tells you when to push and when to wait. Okay, so in a low volume environment, even a well-priced asset takes longer and trades at a wider discount to ask. In a recovering volume environment, urgency is real. Buyers are active and competition drives pricing. So you have to know which environment you're in. And that lets you give an owner an honest timing recommendation, not just a pitch to list their properties, okay? Lastly, number 5, all right? It builds your track record as a forward-looking advisor, okay? That's so important, right? If you can show a client that you called the volume bottom, or you knew where the volume bottom is, and you flagged the recovery, and you position their asset ahead of the institutional capital re-entry, that's not just a broker relationship anymore. That's an advisory relationship. And advisory relationships don't go out to bid. I'm going to say it again. Advisory relationships don't go out to bid. We're live here on LinkedIn today. This is Logan Freeman, a Kansas City Commercial Real Estate Market Pulse, Season 2, Episode 11. Drop your questions in there for me. So let me get to some of these, points and I think markers that you should be tracking kind of on a regular basis. All right. So this is from the Altus Group. They put out fantastic information, all right, in regards to tracking real estate volumes. But 2025 surprised everybody. Through Q4 of 2025, 46,395 properties transacted. That's up 3.9% quarter over quarter and 2.2% year over year. So office was up 2.9%, multifamily was up 3.8%, and hospitality was up 85.9%. And that outpaced the overall annual growth rate, while industrial just rose 1.4% and retail activity was effectively flat, okay? But the aggregate transaction volume total $179 billion in Q4 of 2025. That's a 20.7% increase from the prior quarter, and that's up 20.2% year over year. Industrial drove most of that annual growth, surging 54.4% to $44.9 billion. And that accounts for just under a quarter of the total activity, all right? Now, this is a really cool graph. And you guys, if you want this website, just send me a message. I'll send this to you. Send me a DM here on LinkedIn. If you're listening on the podcast, my email is logan@mwcreadvisors.com. I can be found on LinkedIn, also on our website, www.mwcreadvisors.com. We're dropping a lot of these insights on the newsletter, so definitely sign up. Get added to the LinkedIn newsletter where I write weekly, as well as our deal list through the website. But you can see, man, look at 2025. There's that $179 billion there, right? If we just track over, we didn't see that volume. We haven't seen that volume since Q3 of 2022. Sorry, Q4 of 2022. Okay. So really, really interesting to take a look at. They also have the counts year over year, the dollar volume year over year in all the different submarkets. So if you're interested in taking a look at that, go check it out. We got some really good price per square foot that you can take a look at, and the pricing per property sector. Okay, so that's number one, is transaction volumes being up in 2025, up about, in Kansas City, I'm going to show you, it was up about 67%. Okay, the other thing I want to show here is leading indicators. Okay, and this is the Lightbox Commercial Real Estate Activity Index. It rose 28% in January to 110.7. All right, that rebounded from December's 86.7 and marked its first return to triple digits since October. And the reading also surpassed 88.2 1 year ago. So that signals renewed transaction momentum to open 2026. And this index is really cool because it aggregates commercial listings, lender appraisals, phase one, environmental activity, which reflects improving capital deployment and underwriting activity despite maybe even the soft labor data and uneven inflation signals. So listings rose sharply from December's seasonal lull, while the appraisal and environmental volumes posted strong year-over-year gains, which reinforced a constructive start to the year. So that is a big marker that I'm watching. Anecdotally, I will say that for the listings that we have and the projects and the buyers and the transactions here in the Kansas City market, we are seeing the exact same thing. I mean, we have over 110 CA signed on one of our multifamily listings, 110 confidentiality agreements signed on that property. So Lightbox's take here, and again, if you want this information, make sure to send me a DM on LinkedIn or send me an email to logan@mwcreadvisors.com. Would love to connect with you. But Lightbox's take here was January's rebound suggested that commercial real estate is building on a stabilizing foundation, right? Lending is firming, bidding pools are deepening, and institutional capital remains engaged. While private equity volatility and macro uncertainty bears watching, a more dovish rate environment, particularly if the 10-year treasury trends below 4%, which last week it was below 4%. I think we're just right above 4% right now. That could support refinancing, pricing, and deal velocity. Okay, so the market's unlikely to surge, but incremental improvement appears well within reach as 2026 unfolds. So you should definitely take a look at this information. I would say that most economists are looking for a 16 to 17% increase in transaction volume here in 2026. And January, February, and the Lightbox, leading indicator index is really showcasing that as well. Now I want to shift a little bit, okay? Because this is a big story that I'm going to talk through next. So let me present something to you guys here. So I'm going to share this screen here instead of this graph. But this was really interesting. If you're thinking about it from an owner's standpoint, let me get this shared real quick. Just going to remove that. All right. Let me make this a little bit bigger for you guys to see. There we go. All right. So commercial real estate is cheaper than stocks for the first time in 20 years. And what I'm going to walk you through today is a market signal that I don't think comes around very often, maybe once in a generation, right? MetLife's latest institutional data shows that commercial real estate is now cheaper than US equities for the first time in nearly 20 years. That's not a headline that I'm spinning. It's a valuation fact, right? So by the end of this brief, this market signal, you're going to have everything that you need to tell the story, right? And to understand what you should do with your portfolio, with your asset, right? With confidence and conviction, okay? So let's start with the data, right? Commercial real estate valuations measured using the inverse of cap rates, so that's the real estate equivalent of a PE ratio, have fallen below US equities. And the last time that this happened, the iPhone didn't exist. The last time this happened, the iPhone didn't exist. And the S&P was under 1,500. So this isn't just noise, it's a generational repricing signal, right? And most investors haven't noticed yet. And that gap between data and sentiment is exactly where the opportunity lies. All right, so I'm going to decode this just a little bit, right? To understand why commercial real estate's cheaper than stocks, we just have to unpack the core valuation metric. That's the cap rate and its inverse. So the cap rate is a real estate investor's expected rate of return on a property. So it's calculated as net operating income divided by the property value, right? So for example, if a building generates $100,000 in NOI and it's valued at $1 million, its cap rate is 10%. Okay, so just wanted to kind of think about that. In the stock market, the price to earnings ratio tells you how much investors are willing to pay for each dollar of earnings. So it's calculated by share price divided by earnings per share. So since cap rate is essentially earnings divided by price, its inverse, 1 divided by the cap rate, acts like a PE ratio for real estate. So if a property has a 10% cap rate, its inverse cap rate is 1 divided by 0.1, which is 10, right? And then when this real estate PE of 10 is lower than the average PE of the S&P 500, it signals that commercial real estate's trading at a relative discount. Okay, so how do we get here, right? To understand where you are, we need to understand how we got here. Starting in 2022, the Fed's rate hiking cycle forced cap rates higher, which mechanically compressed asset values even when income held steady. So the office sector piled on, right? Triggering a broad institutional flight from commercial real estate. The NFI ODCE redemption queue, that's the clearest measure of institutional panic, peaked at 19% of NAV in 2023. That's a historic exit surge. But here's the key. That process has run its course. The reset happened, and now we're on the other side. Look at this chart, right? The redemption queue has dropped, okay, from 19% at its peak to 12% in early 2026. Private commercial real estate values bottomed in late 2024. So the bid-ask spread that froze transaction volume, that's narrowing. Investment managers are now projecting nearly 5% price growth in 2026. So the bottom is in or very close to it, right? And the institutional capital that fled is beginning to come back. And that's the signal that matters the most right now, okay? And here's the dynamic that you need to understand. Institutional capital is enormous. A lot of times it's slow moving and it's consensus driven, right? It doesn't necessarily lead cycles, it follows them. So by the time the big pension funds and endowments have committee approval, they've raised the capital and they've redeployed it into commercial real estate. Prices usually have already recovered meaningfully, right? So the window to buy at the reset is right now. And when the data is clear, but sentiment hasn't caught up, that's asymmetry. That's the opportunity, and it's not going to last. So here are 4 sectors that I think have the most compelling risk-adjusted returns, and not all of commercial real estate is repriced equally. All right, I've been saying this is this year is a bifurcated market. Right, MetLife's sector analysis points to 4 asset classes worth focused attention: senior housing, infill industrial, medical office, and net lease retail. And each has a distinct thesis. We could do an episode on each one of those. But I'm going to walk through the most compelling in detail. But the common thread is that all 4 have structural demand drivers that held through the correction and are now accelerating. Okay, so let's talk about senior housing. It's the clearest demographic play in the country right now. right? Baby boomer demand isn't a thesis. It's a census fact. The wave of aging Americans needing senior housing is structural, it's predictable, and it's accelerating. Meanwhile, the new construction of pipeline is constrained by elevated financing and land costs. So supply can't keep up with the demand, and institutional indexes already show that senior housing is outperforming the broader commercial real estate recovery metrics. So the window to buy before pricing really fully recovers is narrowing, and that urgency is real. Reach out to us. We have projects in the senior living and the senior housing space. Okay, so we do have active deals listed as well as off-market opportunities in this space, because it's definitely one that I feel is got a lot of tailwinds behind it. Now, office is the sector everyone's afraid to talk about. So let's talk about it directly. National vacancy is at 18.8%. That's ugly. Class B suburban product in slow growth markets is a genuine value trap. Not a lot of people are touching it. But here's what the headline is missing. Net absorption turned positive for the first time this cycle, right? Class A product in high growth Sunbelt markets, Miami, Tampa, Fort Lauderdale, that's fully recovered. The bifurcation between winners and losers has never become more extreme, right? Your job is to know exactly which one to be in and why. So reach out to us about office projects. We just sold a medical office building here in Kansas City. We've got more of those opportunities available. So if you're looking for medical office, please do reach out to us. Logan at mwcreadvisors.com. Link up with me on LinkedIn. Go to our website, www.mwcreadvisors.com. All right. So what I'm going to tell you guys from the key takeaways here is I want to take you through four things to remember here. Number one, commercial real estate's cheaper than equities for the first time in 20 years. That's a generational sign, all right? Number two, the bottom is in or close to it. Values bottomed in late 2024. 5% growth is projected for 2026. We had about 1.5% growth in 2025. Number three, the entry window is open right now before institutional capital fully redeploys. Number four, the sectors to own are senior housing, infill industrial, medical office, net lease retail. And the folks who are working on those types of opportunities are going to win right now. The other thing that I will say that I've seen a lot of surge in is continual renewal and interest in the build to rent communities, small bay industrial, which kind of fills this infill. And obviously, there's an asset class here that a lot of people are interested in, hard to play in, but it's the data center world. So those are all some kind of key takeaways from that report that I put together. I'm going to shift over to something else that I think is really interesting for you guys to focus on, which is that the 40-year party is over. So if you're a seller, you're thinking about selling, okay? So I'm going to put this into my presenter view. Yep, there we go. So make sure you guys are seeing this now. All right, great. So we've talked about transaction volumes going up, 10-year treasury hanging out or below 4%, super important for deal-making activity. The bid-ask gap has definitely shrunk. It's narrowed. Institutional capital is starting to come back, but not quite there yet. And the opportunity, if you are a seller, while we have 5% price appreciation this year, liquidity is in the market, the trend is your friend, you should be thinking about, should I be selling right now or holding on? Now, obviously, there's a lot of things that go into that discussion and that decision. But I'm going to give you something to really think about, and that is that the 40-year party is over, right? I'm not criticizing anybody in the room, right? But everything that we're covering today starts with one idea. The environment that made most commercial real estate track records look great over the last 40 years no longer exists. And that changes everything about how we evaluate deals and our own assumptions, okay? Check this chart out. Shout out to CRE analysts. I thought this was so interesting. What is $1 of NOI worth, right? So $1 divided by the average cap rate in, let's just pick a date, right? 1981 was $7.39. 2022, that same dollar is $17.88. Why? Well, let me talk about this for a second, okay? In 1981, $1 of NOI bought $7 worth of real estate value. Cap rates were around 14%. In 2022, $1 of NOI bought $18 worth of real estate value. Cap rates were at 5.5%, right? So 14% to 5.5%. That's not a market fluctuation. That's a generational shift, right? So 157% gain in valuation multiples with zero operational improvement. Now, I'm not saying that they didn't operate well or add value, but let that sink in, right? 8 to 10% of annual returns that had almost nothing to do with skill. So if you annualize what this compression looks like over 41 years, cap rate compression added approximately 2.3% per year to every commercial real estate investment in this country, automatically, structurally, quietly, just for being in the game. You stack that on top of 6 to 7% income returns tracked for institutional grade properties, and you get 8 to 10% consistent annual returns that had almost nothing to do with the operator skill. Let that sink in for a second, right? The macro did the heavy lifting. So this 40-year ride from high inflation and high interest rates down to the nearly zero era of 2010 to 2021 was a one-time event in modern financial history. It happened once. I'm not sure it's going to happen again in our investing lifetimes, right? 230 basis points per year, automatically for 40 years. So that illusion box is the most important point. Strong IRRs mask mediocre operations. So, how do we know which is which? That question sets up everything that follows, right? But cap rates do not have another 900 basis points of room to compress. We're not going from 5.5% to 3.3%. That chapter is closed. All right. So this chart here visualizes the compression cycle. This is the story of the last 4 decades in one image. The line goes one direction, down, and it's done going down, right? There's no more room. So what replaces it, right? 4 decades of cap rate compression, it delivered a structural tailwind worth, again, roughly 2.3% per year in free return to every holder of institutional grade real estate. And that era is over. The line has nowhere left to fall, right? The bad news was the last 4 slides, but this is where we go to the opportunity, all right? 3 sources: NOI growth, basis discipline, and value creation. And all 3 require genuine skill. And that's actually good news for operators who have it. It's very good news. But without cap rate compression doing the heavy lifting, returns must be actively generated through NOI growth, through basis discipline, and through value creation. Okay. So if you have harvested that, right, you've had your NOI growth, you have a good basis, you've created value. This is a really, really good time to think about selling. I talk a lot about the 18.6-year real estate cycle. Why do I believe the transaction volumes are going to be above $600 billion nationally? Well, I forgot to show you, but in 2025, Kansas City almost did $12 billion of commercial real estate deals. I've been tracking that for the last 6 years. Nothing's come close. 9 billion is the closest we've been. In an interest rate environment of 2021 and 2022, which was, basically free money. 2025 blew it off the water, 67% increase in 2025. All right. So I think some sellers do realize that that line of 40 years of cap rate compression is over. And so if you have created NOI growth, if you have a good basis and you have generated value, the opportunity really is to go harvest those values right now. Okay. And so one thing that I've been thinking a lot about is the skill versus the tailwind. That's the question that no one's asking hard enough. How much of this track record was skill and how much was the market doing the work, right? A sponsor who generated 15% IRRs from 2010 to 2020 may have been exceptional, or they may have been an average operator riding a once in a generation compression cycle. You really can't tell the difference by looking at the return number alone. The headline number, IRR number, is not the answer. It's just the beginning of the question, right? So you have to look at the performance through the ugly periods. These 3 windows, 2008 to 2010, 2020, and then 2022 to 2023. These are your due diligence checklists. Walk through each one. Emphasize that it's not just what happened, it's how they answered the question, right? These are these are very specific things that happen, right? And this is what you're listening for and looking for if you're looking at a real estate investment, all right? So if you're an owner, right now, thinking about selling a property, in 2026. What we have laid out today is transaction volumes were way up in 2025. 2026, the leading indicators from January are at levels that have not been seen since October of last year, which created a huge Q4, $179 billion nationally done. And this is the type of stuff that we work with our clients on a regular basis. It's not just, hey, let's look at, recently sold deals. We have to look at the structural shift in demand of your property. I think 2026 is a real important time to be evaluating that. I mean, we've been going on property tours left and right with owners, and we lead with this type of information, these types of questions, these types of conversations, because holding mediocre assets and watching compression deliver returns is no longer a strategy. Basis, NOI growth, and genuine value creation are really the only paths forward, right? So advisors on our team who are bringing this analytical depth, they're winning deals. So we're using this skill versus the tailwind framework to differentiate every client conversation from this point forward. So you have to be thinking about this. If you're a portfolio owner, will this create opportunities in the marketplace? Absolutely. 100% it will. But generally speaking, from the data that I'm tracking on a regular basis, the leading indicator, the lagging indicators of what's happening in the commercial real estate market, specifically in Kansas City, we believe this is a great time to really be evaluating your property for a sale. If you're a buyer doing a 1031 exchange, reach out to us. There are opportunities out there. And if the 10-year treasury continues to hold at 4% or right below that, it's deal-making activity. So I put out a piece on my newsletter, it was last week, all about the different spreads that we are seeing from banks right now on the lending side. Okay, so you can go look at the different asset classes and the different spreads. If you're interested in speaking with any lenders, we've got plenty of lenders I can get you in contact with. Big shout out to Shane Engelken, First National Bank of Hutchinson, Kansas, really putting out great content out there. So appreciate you and everything that you do in regards to the financing side. But this has been another episode, Market Signal, of the Kansas City Commercial Real Estate Market Pulse. We're excited to continue to bring you this information. Please do reach out to us. The team is working hard on putting out 10x more content than any other commercial real estate firm here in Kansas City. We are in a lot of developers' pockets. Please do go check out our planning and zoning meetings. We're covering Lenexa, Overland Park, Olathe, Blue Springs, Lee Summit, Kansas City, Missouri, in regards to what's going on in the planning and zoning communities. Those are like 5 to 7 minute episodes. You can check those out. Those are put out every single month for every single one of those municipalities. I think it's important to work with advisors that are spending the time in this data, understanding where the market is headed by looking at the data and making those data-driven insights. So reach out to us, Logan at mwcreadvisors.com, www.mwcreadvisors.com. We got 2 new listings coming up. Looking for a fourplex. Got a great one over by KU Med. Looking for a mixed-use asset. Really cool project over on 2510 East 85th Street coming to market. So make sure you get on our list. We got new deals coming almost every single week right now. Feeling very strong about 2026. Working with a lot of owners in regards to understanding their value, where it could be headed in the future. Even working on some refinances for some groups. So please do reach out to us. Thanks for tuning in for another episode of the Kansas City Commercial Real Estate Market Pulse.